A UK Chancellor Rachel Reeves has delivered her long-awaited budget, raising billions in new taxes to build up a fiscal buffer and pay for increased welfare spending. But the Chancellor's announcement was overshadowed by the unprecedented early accidental release of the details of the budget and the economic forecasts that underpinned it by the Office for Budget Responsibility, almost an hour before Reeves began her speech. Those forecasts showed a weaker outlook for the UK economy, growth expectations downgraded for each of the next 4 years, as the OBR lowered its forecast for the UK's productivity. We spoke to OBR Budget Responsibility Committee member David Miles about the outlook.
The underlying rate of growth of productivity in the UK is a bit weaker than we'd thought. We haven't really seen a bounce back in productivity growth after the big shocks of COVID and the energy price rises in 2022. And now enough time has passed for us to think that probably productivity growth will be a little bit weaker than we thought. So that's one of the main factors behind relatively slight downgrade in the growth projections. Of course, it's very difficult when a government raises taxes on a large scale, and this was a big tax-raising budget, to simultaneously boost growth, because it's very difficult to increase taxes without that having some side effects. They were offset by some other things in the budget, but the net effect is that the budget as a whole hasn't, at least over the next few years, boosted growth, because there's offsetting pluses and minuses.
The tax rises announced in the budget are forecast to total £26.1 billion annually in the 2029 to 30 tax year, adding to the £40 billion of tax hikes Reeves delivered last year. That is projected to push the UK's tax burden to over 38% of GDP, a new post-war high. The increased tax level comes from what has been described as a smorgasbord of measures, after Reeves reportedly ditched a plan to raise headline income tax rates. The three biggest revenue raises, well, income tax thresholds will remain frozen until 2030-31. Tax benefits for pension contributions will be cut back, and income tax levels will rise on property, savings accounts and dividends. The OBR says the Chancellor's tax changes will create £22 billion of headroom against her fiscal rules, the most left by any Chancellor in the past 3 years, and more than double the amount forecast in the spring statement earlier this year. Ian King spoke to Economic Secretary to the Treasury, Lucy Rigby, and asked about the decision to keep tax thresholds frozen.
Well, we've been clear that we've stuck to our manifesto, which is what everyone, of course, wanted us to do. We have had to freeze the thresholds. You're absolutely right, and the reason we've done that is to try and make sure that we are keeping taxes on working people as low as we absolutely possibly can. And you'll remember that's what we said in our manifesto. That's what we committed to do. So you're right that there is an increased burden, but what we've done with the package that the Chancellor announced today is to keep the burden on working people as low as we possibly can.
But is that really true? I mean, if you look at the OBR costings, 980,000 people are going to be dragged into paying the higher rate of income tax by the end of this Parliament. That doesn't feel like a budget for working people. We've
stuck to the terms of our manifesto, which is what we set out to do. We've kept the burden of tax on working people as low as we possibly can. And today, the Chancellor was able to announce, she told the Chamber, that growth has been upgraded. And of course, you will have heard the Chancellor doubling down on all of the conditions for future investment and indeed for future growth. And there are a myriad of ways in which we are doing that. She's also made a priority of this budget getting debt under control. It's really, really important that we do that. So debt's going to be falling in the last couple of years of this Parliament. And as I said, the Chancellor's made a priority in this budget getting our debt under control.
And one of the biggest questions going into the budget was, will the bond market be happy with what has been announced? And the short answer is yes, because if you take a look at the 10-year gilt, the yield down some 6 basis points over the course of the day. Of course, there was some volatility given the early release of the OBR figures, but also if you take a look at the 30 yield, down almost 10 basis points. That was the biggest one-day fall since April on the back of the bigger than expected fiscal headroom of £22 billion. So that's positive news. Earlier today, we spoke to Conservative Shadow Chief Secretary to the Treasury, Mel Stride, who criticized the government for its spending plans.
It was a difficult backdrop because of what she did in her first budget, which is to load up businesses in particular in the UK with lots of additional tax, and that's been part of the growth destruction story in the United Kingdom. What we would have been doing would have been getting on top of the size of government spending, particularly welfare, where we have elements of the welfare budget that are really spiralling out of control. We've got around 3 to 4 million people on health and sickness benefits, no conditionality attached to them, no requirement to look for work and so on, and really tackling that is absolutely key.